So after a very informative discussion with the commissioner, we'll now move on to our first panel of experts, and that'll be moderated by Gina Chon from the Financial Times. And this first panel will have a discussion on market stability in the digital age. Thank you.
Hi, my name is Gina Chon. I'm here from the Financial Times. Thank you to all of you for joining us, especially if any of you, like me, stayed up to watch the GOP debate, which went on far longer than any of us expected, even with some of the antics. So we appreciate your presence here. So we're going to be talking today about a pretty important topic that is getting increasing attention from regulators, from law enforcement agencies, and obviously market participants as technology increases speed, makes possibly things smoother and more automated, but we've also seen various glitches that have caused people to question the stability of our markets. This year, obviously, we saw the New York Stock Exchange having its stoppage that it said was related to some software upgrade issues for several hours. Obviously, the flash crash from the past, August 24th was mentioned earlier. So there's been plenty of things in the markets that have caused us to question, where this is all going. So we have a panel of experts here from both the buy side and the exchange side and various other parties who could talk about this. So just wanted to throw it out to you guys. And I guess, Andy, one of the things you had talked about before we started was, wanting to have sort of a broader view of this issue of market stability in the digital age, going beyond just, technological issues, but also just the regulatory framework, both here and globally. So just wanted to get your sense of, what you think of the state of the markets today, and are they stable?
Well, thanks for teeing that up, Gina. Generally, the markets are stable. And generally, the markets work well, and they open at 9:30 sometimes, some stocks. And they generally close around 4, though not exactly at 4 o'clock, I can tell you. But, I think August 24th is the latest example of some challenges that we all face. And frankly, markets have always faced these challenges. So if everyone is trying to get on the same side of the boat at the same time, markets really can't handle that. And there's going to be disruption and there's going to be dislocation. But one of the things that's always been troubling to me is we, as an industry, we don't seem to be very good at revisiting things and acknowledging that maybe we've made some mistakes and that we made some decisions that, probably we need to look at. And for example, limit up, limit down, I think after the flash crash, terrific idea. Doubling the bands of limit up, limit down the first 15 minutes of trading now looks to be a terrible idea, in my opinion. And so what do we do about that? How do we go back and say, geez, we gotta change this up? And since Gina teed this up, I guess I do want to mention 2 other things. So market stability is a broad issue, and instability is a broad issue. But destabilizing things can come in a lot of different forms. And for a global asset manager like T. Rowe Price, I can tell you the prospects of ESMA and the FCA fully unbundling and making commissions not eligible to buy research is really going to be destabilizing. And it's not going to be limited to the continent or to the UK. That's going to affect everybody. And I don't know if we're really talking about that enough. And we at T. Rowe Price like to be a big-time consumer of research in Wall Street that things offered, and a modest payer. And that's been a pretty good value proposition for our clients. And if we change that, who's going to suffer? The client base. Now, another thing that's really below the radar screen, but will also be destabilizing in a different way, is The SEC, in a Division of Investment Management release on guidance in February of this year, talking about 17E1, gifts and entertainment, is essentially pushing the envelope a little bit to almost imply a cup of coffee is an inducement. And I have no problems buying my own cup of coffee, but I am interested in encouraging discourse and engagement with people that are helping us manage money for our clients. And if we eliminate that and make that really hard, clients are going to suffer. Information is going to be withdrawn. Opportunities are not going to be as obvious as they could be. And that's, I'm not sure we've thought through these things. And I would urge us as an industry to start thinking about, wait a minute, is that really what we want to accomplish? So pretty broad, thanks for that tee up, but I'm sure Chris and others, we can dive into particulars better than that.
I'll follow up. I think you covered a lot with that open-ended question. So I thought you were going to go into the political race as well and cover that topic.
Well, there's also stability.
Because that is destabilizing. When I see Trump, I'm destabilized.
That's right.
So, look, the one thing you mentioned August 24th, and I think I agree totally with Andy. I always agree with Andy. We're all supposed to agree with Andy. It's good advice to agree with Andy. The other thing that this industry doesn't do is it doesn't ever pat itself on the back. It never says, what did we do well? We always jump to, well, what broke and what didn't work and what should we fix? And August 24th was an amazing day for the infrastructure of this industry. We were overwhelmed by message traffic. It was a doubling of message traffic from the peak of 2008, which was an explosion of message traffic. And not one system broke. Sure, we had limit up, limit down things that we need to fix. We have too many halts going off in certain symbols. There's certain things we can do around the open, but nothing broke. The entire infrastructure was overwhelmed by message traffic. Every broker, every algo was hit with a storm of messages, and it all worked. And no one wrote a story about it. And unfortunately, when it breaks, we get stories, but when it works and it works perfectly, we don't get a story. So that's the other thing is we have to step back and look at, wow, we did do some things correctly. We put systems in place, we put capacity in place, and it all worked. Now, we have to take a step back and look at the things that didn't work, and there's a list of things around ETFs particularly, where we have limit up, limit down, and an entire stock market regime that doesn't incorporate the concept of a derivative or an ETF, which is a separate instrument from a straight stock. And so we have to look at the limit up, limit down, and the auctions that we come out. Everyone, ironically, uses a different auction when we go into a halt. Whether it's NASDAQ, New York, or BATS, we have different non-standard halts. We halt at the same time, but when we come out and run an auction, they're all different. And that actually destabilizes many of the market makers and how they interact with these auctions. So great lessons learned, but really a time to be proud of what worked that day.
Yeah, no, that's a good point, and I'd be curious to get your thoughts, maybe Sapna as well, just on what you think the lessons learned are, but also whether the lessons learned need to be sort of incorporated quicker, because as I think Commissioner Piwar mentioned, Reg NMS, certain things that occur in reaction to what's happening then stays in place for years, which may not apply any longer.
Sure. I think I agree with Andy, just to begin with, that the markets are generally stable.
See, I told you.
Everyone agrees with Andy. I also agree with Chris in that we don't get patted on the back for the things that we do right. And we have put in place a lot of things that are right, and they help the marketplace. And August 24th was an example of that with the circuit breakers. But just to take the other side of that, there are a lot of things that destabilize the market, and not addressing single points of failure, I think, is something to kind of highlight. Whether it's the New York Stock Exchange issue on July 8th, whether it's the NASDAQ TRF being down earlier this year, whether it's SIP outages, These are all things that we know that we need to operate in the marketplace for us to be able to trade efficiently. When you think back to 2013 when NASDAQ had their issue with the SIP, when we couldn't trade NASDAQ-listed stocks for 3 hours, Chair White called the exchanges down to Washington and said, identify these single points of failures, and everyone focused on it at that point. Fast forward 2 years later, we haven't addressed them. And so I think that's a big focus if we want to look at things and we want to fix things. There's a lot of media and a lot of concern when an issue does happen, like July 8th or the TRF issue or even August 24th. And then when that hysteria kind of dies down, I think a lot of the work towards fixing it dies down as well. So I think that's something we need to focus on as an industry.
Well, I'll turn that to you, Stacey. Just in terms of going forward, there's a whole review going on at the SEC in terms of market structure. The CFTC is looking at this issue, as for a lot of other regulators. Do you believe that some of these rules that they've actually worked, that they've done what they were supposed to do, or do you think at times there are too many unintended consequences?
Yeah, I would say, first of all, most importantly, I also agree with Andy. Yeah. I think that...
That was a rule, by the way, for anyone joining the panel.
I'd like to go to page 2 of the things I want to work on here.
And I happen to also agree with Chris and Sapna, because I think that we have done a lot of good things in the industry, and I think the changes have largely worked. And this was the first major, August 24th was the first major event where we saw limit up, limit down under pressure, and how, given the time that we implemented limit up, limit down, and seen growth in the ETF space, this is really a more significant event with ETFs, and we're already working, almost instantly coming out of that event as an industry to see how we can improve how limit up, limit down is used within the ETF space. And the ETF investor profile has changed over years. There's a lot more retail investment there. And I think that we can look at changes, and when we talk about the auction differences, I think in many ways they are, they ought not to be the same, because there are, to Chris's point, ETFs are a derivative product. We shouldn't try and treat them like stocks, and I think it's appropriate to have different models around ETFs. I do think, though, when we talk about market stability, a big piece of that also is investor confidence. And when there's a lot of complexity in the market and investors feel like they don't understand what's happening, I think that's another area that we need to address. So that's a big focus of ours as well.
Yeah. Well, and then going to ETFs, especially as they do become increasingly important to investors, Daniel, what are your views just on what needs to be done to make that market more transparent when it comes to pricing and other issues? And the SEC is also doing a review and has surveyed market participants on that front. It's even possibly looking at some enforcement actions there. Where do you think this needs to go?
So I think it's really good advice to always agree with your clients. But for any students out there, let me give another good piece of advice. It's always good to compliment and quote your boss when you're in public. And while Chris is my second favorite CEO in the country, my favorite is Jamie Dimon. And one quote that he often gives is that the United States has the widest, deepest, most transparent capital markets in the world. So let's start with that, all right? And that's more Chris's point also. Let's pat ourselves on the back for what we have here. Are markets stable? They are stable for the most part. Sometimes they have instability. Our markets, sometimes they widen out. Sure they do. But for the most part, they are the deepest, the widest, and most transparent. All the changes that have gone on throughout the years have, for the most part, benefited all investors. But that doesn't mean it's perfect. It doesn't mean there's not room for improvement. So let's focus on that. ETF is a perfect example. ETFs, relatively new phenomenon when you think about the history of the exchanges. And obviously they're booming, and I think until 2-3 weeks ago, people probably thought they were perfect, and now they realize, wait, there's something we need to improve. So that's, after August 24th, there's something we need to look at. There are a lot of ideas being floated around how can you apply limit up, limit downs to ETFs. I mean, the commissioner was talking about that before versus stocks. Let's address it level-headed, but with the starting point of we have a really good marketplace here that needs some improvement. right? Let's not break anything, let's just improve it.
Well, building upon that and where things can be improved, I'd be curious for both Andy, Daniel, and Sapna, just because of where you guys sit, what you thought of the NYSE shutdown in July, for a few hours, what that did for you guys, but also what it said to maybe Chris's point of the resiliency of the markets, that there were other venues for trading, and so it was obviously of a concern, but it's not like it was a catastrophe.
Sure. For the most part, July 8th was not a big deal for us and for my firm. I think early on, and Stacy can speak to this, maybe communication could have been a little bit better, just overall in terms of what was going on. Communication in the afternoon between the New York Stock Exchange and those of us impacted from a broker-dealer community was fantastic. They were asking advice on how they should reopen the markets, and we were working together to do that. The pro of and the benefit of Reg NMS is that we have the ability intraday to basically shut off a venue if they're having issues. So those of us who were routing to the New York Stock Exchange and Amex that day, we had the ability to basically what we call self-help those exchanges. And this is where a lot would say fragmentation benefited us that day because there are many other venues that you can route those orders to. Market volume was not impacted that day. I think the concern for us with respect to what happened that day was more around the close and whether or not the New York Stock Exchange was going to be able to reopen to close stocks that day. And I think it became critical for us, especially in the last hour, where we have to make a lot of decisions. And when 3 o'clock hit and both exchanges, Amex and the New York Stock Exchange, weren't open, we were scrambling. So we needed to figure out how we communicate to clients on how we're going to handle their on-close orders. We had to figure out whether we needed to readjust algos to account for the fact that there might not be a closing price. And so I think that's something that was highlighted that we've been working towards even after that with the New York Stock Exchange, with NASDAQ, with some of the other exchanges and participants that were impacted that day.
Yeah. Andy and Daniel, and then Stacey, I'll let you.
So Sapna, I think, identified this well, that this sort of single point of failure issue is a challenge. And, we have a business continuity site. We used to call it disaster recovery, but I think that's politically incorrect, so we call it business continuity. And we practice twice a year. And I think in terms of things like planning and the consolidated audit trail and all these things that we want to get to, we really do need to have redundancy of things that are so critically important, like the opening and like the close. So if there's not a close, how do we price? How do we come up with a net asset value? That's a huge issue for us. And, I think New York has a couple exchanges under their umbrella, and they could probably employ one of those maybe, and BATS might have an additional, and NASDAQ might have an additional. We've got 11, I think, in this country. So probably the only time we're in favor of fragmentation is if we needed full redundancy. That's probably the right time to utilize it. But I would hope that as a result of some of these outages and some of these challenges, we would finally get to, okay, what are the contingency plans? What do we do if we can't close on NASDAQ or on BATS or on the New York? What's plan B? And make that, push that out and make sure everybody's aware of it so that they can plan for it and it can work. And we ought to practice that somehow. And so that was pretty scary on the prospect of not reopening. The intraday stuff, we hustle around that. But I think that, if an exchange, if the primary listing exchange is responsible for both the opening and the close, they've got to have full redundancy in that process.
Yeah, just to quickly echo that, when you think about the trade process, when a buy side wants to send an order to the sell side, they have multiple ways of getting me orders, right? Multiple execution management systems, order management systems, networks that they go over, backup networks. I have more than one box running all my algos. I got multiple boxes in multiple data centers that I can fail over to. I got backups all over the place. I've got multiple connections to Chris's exchanges and backups. But the point of failure, the single point of failure, is that open and close. And even if it doesn't open, stocks still trade, right? They do trade. It's just not as cleanly as they should. But we do need to think something about getting backups to the close. And to the exchange's credit, they're working on it, right? So
Yeah, I'll just touch on that for a second. So, on the 8th, our focus was really on re-entering the market after suspending trading in the least disruptive manner possible. We know, as Sapna mentions, that we impact our customers. So how we re-entered was going to be, we wanted to ensure that did not have a negative impact on customers. And we took our time so that we could ensure that when we came back up, the closing process was clean and that we recognized the importance of that closing process. And two, we do have redundant systems. So when we did fail over, we did fail over to our backup trading units, and that's why we were able to come up in a clean state for that closing auction, which we recognize is so important. But it did start the conversation around, okay, well, what if your backup systems didn't work, or what if your backup systems didn't work? So we did enter into discussions with NASDAQ about how we could provide additional, tertiary levels of redundancy for the auction processes, because what's so important about that closing process is both the significance of the output of the closing prices and that auction, as well as the input, and that those, getting meaningful values and official closing prices to the industry to be used in fund valuations and the like is really, those prices are dependent on the price discovery process that contributes to knowing that those are really valid prices. So that's why we announced the plan with NASDAQ that we continue to work through and discuss with customers as to what we think will be most effective. But again, I mean, the intraday bit, yeah, certainly you see the benefit of market fragmentation, and we saw in July that it's not so disruptive because trading can happen elsewhere. But in August, you saw the negative side of market fragmentation, where liquidity is dispersed throughout so many different venues. I think it does contribute to market volatility. So our markets have become, so significantly fragmented that, maybe we've gone too far.
Well, Chris, I'd be curious as to your thoughts, sort of watching this from the outside of it.
Sure. Well, NASDAQ's going to back up New York. New York's going to back up NASDAQ. We decided to back up both NASDAQ and New York, just as a favor. I can't, I will never comment on another market's technical issues, because we all have technical issues. There's no one in the industry is free of technical issues. We're running the most complex systems really on the planet. If you look at the internet companies, there's nothing like these systems and the traffic that they see and the complexity, and they're all interlinked. So our systems are going to go down. Everyone's systems are going to go down. We will be judged not on whether or not our systems go down, but on how fast we come back up. And so you can have multiple failovers, but when a switch flaps, you're down. So it's really how fast can you diagnose the problem and get back up, and the simplicity of your system and the backups work great, but a lot of times the industry isn't ready to use your backups. So today we have backups in Chicago. Guess how many people connect to Chicago? Very few people when we want. So if we were to run a primary closing cross in Chicago, it would not work. I will tell you right now, no one can get there. No one can get their orders there in time. At some point, we just can't. If it's 3:45, no one can repoint everything to Chicago. So we just have some physical challenges around these single points of failure. And the key is making sure that your platform can actually recover and get back into the market. So I do think there's a lot of work to be done there. I do think a market backing up another market sounds great, but it's really hard for the industry to, at what time do you tell the entire industry, oh, go to NASDAQ for the close and hope everything works out? And the risk that the sell side's carrying Andy's orders into the close is huge. So it's a really difficult conversation. And it's really difficult to ask the industry to repoint at different things. So, I agree that the markets are going to break from time to time. We saw in July that the market was able to deal with a market going down, and that's impressive. But we do need to work, to Andy's point, we need to work on single points of failure. The SIPs are all single points of failure. Clearinghouses are single points of failure, and the open and close of the primary markets, single points of failure.
I just would add, I think at this point, the industry accepts the fact that there are going to be technology failures. I mean, when we came back up on July 8th, our closing auction was larger than normal. So we didn't have a lot of concern from the industry that that we weren't going to be stable and technology issues just happen. And it's kind of ironic because NASDAQ, New York, and BATS all had a technology show, I think, the same exact week, and it's just how we prepare for them, how we educate our customers on what our actions are going to be when we do have an outage so that they can be prepared. And that's what we're trying to do with the Closing Cross plan is so that they know what steps they would need to take if we're having an issue, because the more transparent we can be up front, I think it helps our customers out.
Well, what about, aside from the sort of inevitable technical issues that is bound to happen, another growing concern of cyber attacks and cybersecurity, where the preparations for that are still a bit untested, and people are definitely trying, at least whether they're successful or not. It's another question, perhaps, and hopefully not, but down the road. But there have been attempts to, hack into the exchanges, try to disrupt markets. What are your thoughts on, what can be done about that?
I mean, we invest heavily in information security. We spend a lot of energy training our employees on how they can protect our organization, just because such a high percentage of cyber breaches come from an unwitting employee, opening an attachment or clicking on a link. So we do a lot of training on phishing and have improved pass rates on those pop quizzes. So certainly that's an area that we're very focused on. We also have internally a business that focuses on educating boards on topics that are relevant to them. So we spend a lot of time educating our listed companies on cybersecurity as well.
Just on cybersecurity, I mean, it's amazing what this industry is being attacked by, and it's rarely in the press how many attacks occur. We work. BATS is constantly attacked. We actually staff up during the holidays because that's when they attack you. The actually attacks come in heavier during all the holidays, so you actually have to staff up. It's reached a level that's a bit scary, and Stacy's right. Your employees are your worst cyber risk. So every piece of email, if we just turned off email, we'd all be much more protected from cybersecurity, but I don't think we can do that. But any file, anything that they open, if you look at all the major hackings from Target to some of the banks, and even the government, it was either a contractor or an employee opening an email. And so you just have such heightened risk that's why we don't have a few thousand people like some of the other exchanges. We have 270 people to reduce our cyber risk, and lower costs and all those other things, but really just focused on cyber risk. So it's a thing that the industry is focused on. SIFMA ran a cyber threat test, I think, yesterday. So we are all, as an industry, coming together. It's amazing the sharing of information that goes on in this industry. DTC has a great product where they share cyber threats and patterns that you have to monitor for. But what's scary about cyber is you put up a moat around your company and your employees, and then inside the moat, and you can spend billions of dollars, and I know JP Morgan spends billions of dollars on cyber, but once it's inside the moat, you actually are just monitoring for weird behavior, either in message traffic over your network. You can't actually find that cyber application sitting. And if you look at the government episode, it was there for a year, listening and taking information. So it's scary when you really get into under the weeds on how we protect ourselves. We build these giant moats, don't let it in, but we're just monitoring our networks, hoping we pick up a pattern that suggests there's someone listening to our network. It's scary.
Well, just because cyber is becoming so important, I'd be curious, Andy, Sapna, and Daniel, to also get your thoughts, especially because the SEC is ramping up its sort of guidance, regulatory scrutiny on this front, and I think looking at more enforcement actions as well.
Look, it's a huge focus for all of us, right? It's a huge focus for my firm. We dedicated a lot of time and resources when it comes to looking at cybersecurity and prevention. To Chris's point earlier, you don't get patted on the back for things that we do right. You don't hear about the cyber attacks that get prevented and that get caught. You hear about the ones that you can't catch. So industry groups like SIFMA and their exercises yesterday, we all participated in. Various government agencies have had cyber security exercises that they put the industry through. I think that's a good example of coordination among different government agencies, exchanges, sell side, buy side, in terms of how we think about these things, and people who are involved raising the right questions. The scary thing when you actually go through these exercises and you learn more about malware and viruses is you can basically change a single string of code and you create a whole different virus or a whole different malware issue that can't be prevented then. So it's very complex, and it's certainly a huge focus for us, for our clients, for the industry.
The only thing I might just add on to is as I understand it, the sharing and the networking that goes on among people that are interested in cybersecurity on the buy side and the sell side has really been terrific. And there's a working group, and everybody's talking. And hey, we saw this today. Be on the lookout. And I think that opportunity to share and try and reduce a risk to the system is really been great. And if we could, all this agreement that's going on up here, if we could capitalize on that and sort of say to ourselves, who fights for the market? When do we fight for the market? When do we fight for the business in toto, everybody's business? At what point can we all say, we got to fight for the market? So August 24th, some things happened that were terrific. Message traffic things, unbelievable when you think about how we process that. But the opening at KKR was terrible. What happened in Celgene right after the opening was terrible. What happened in JP Morgan, opened at 57 3/4, closed at 63 and change on Friday, opens at 57 3/4, in 2 minutes, 180,000 shares trades at 50.85. That's down, another 10%. How'd that happen? Well, we don't trust the designated market maker anymore to look at open orders, so they don't get to see the second wave. So what do we do about that? How do we come together and say, we want to fight for the market. We want to make the market better. That's where we all should be self-interested. And if we could take some of this agreement that we all seem to have occasionally and really apply it to some of these things, it'd be very refreshing. And it would be great to include the regulators. Raise your hand if you're in the room. We'd be interested in talking to you guys too.
Yeah, I'll just touch on Andy's comments since they were primarily about our open as well.
So let me add on to that if I can. I'm interrupting. Celgene's a NASDAQ stock, and I didn't talk about XL, which traded on maybe every other exchange in dark pool before the primary stock opened. That one closed at 37, traded as low as $5 before the primary market opened the stock. Are you kidding?
So I totally agree with Andy. There's just no way not to. But I would say, our opening process, because it's been referenced a couple times that we didn't open at 9:30, and that's true because we prioritize price discovery over speed, and that's intentional and deliberate as part of our opening. And when we look at overall volatility in our opening versus fully electronic openings, we are largely less volatile by 50%, even for securities that opened in the first minute of trading on the 24th. Sure, you can look at particular one-off situations, and we do look at those and examine those, but across the board, they're less volatile. And it's because we're not focused on just opening right at 9:30. We're focused on establishing the right level of price discovery before we open that security. And that's what we hear from our listed companies is important to them when they choose to list on the New York Stock Exchange. We hear time and time again that having that human judgment element in the opening process is important to them, especially during times of volatility like an IPO or like a day like August 24th. So that's something that we think, sure, you can open at 9:30 every day on the dot, and that's great for professional traders, but the market isn't just about professional traders. And so, we feel like it's important to protect investors and our listed companies.
So, look, we tell investors we're going to open our markets at 9:30. We make that commitment. For a human somewhere on a floor of an exchange to decide when he's going to open his stock, it's downright inappropriate. We never gave the right of our market open to a human who has a P&L interest to decide when he's going to open the market. More importantly, the market is open. At 9:30, NASDAQ, BATS, Chicago, NSX, they're all open. Those stocks are trading. So yes, it's less volatile when you open a stock when the market's already open. If I could see bids and offers sitting down on the floor of the New York across the market, I know exactly where I can open the market and trade and make a P&L gain. And if you look at KKR, if that's what it means to delay an open, then please open at 9:30. The specialist in KKR stole money from investors on the 24th, and he needs to give it back. That's how bad that open was. Opened at 10 when the market was trading at 17. So look, if you want to have a manual open and have price discovery, have it, but get in early. Our market's open at 9:30. Investors are trading at 9:30, and they're wondering where their orders are when they're stuck on the floor of the New York Stock Exchange. That's not the commitment we made to investors. We open at 9:30, and if you want to have price discovery, get in early.
So it's interesting, just serving as a role and arbiter here between the two sides. So the reality is, this is an example where both sides are right. Both sides are right. This is important. Stocks do have to get open, and they got to get open quickly. But price discovery is really, really important. And I would suggest that opening at the wrong price is not good for anybody. So how do we do that? How do we bring more technology, more automation, more of the time to an opening process? And by the way, you know, Rule 48 had some good intentions, but geez, just when you need all the information, and we've doubled the limit up, limit down thing, and you got 48 where maybe it doesn't get disseminated, ooh, that's kind of a bad cocktail. So price discovery is really important. The opening price should be a clearing price for the most part. And what happened in both Celgene and GE and JP Morgan was it wasn't, because within 90 seconds, you had huge dislocation. We got to figure that part out. But we do have to get open, or we have to say, you're opening, if the futures are down 5%, you can't open down 15%. It's not relevant. How did you come up with that number, KKR? And by the way, I'm told that specialist firm bought less than 5,000 shares, opening a stock down 51%. So that's even more extraordinary, you know, because there wasn't a P&L motive. There was just stupidity. I don't know what it was. But everybody's involved here. NASDAQ doesn't get a pass. Their openings weren't great. They were at 9:30, but prices were bad. So how do we, so you got the spectrum here. A lot of academics. You want something to work on? This is a great subject. Jim Angel, come on now. Right? Let's get on it. Rena, it's on its way. Well, you know, I'm 59, and I don't know how much longer I'm working.
I'm sure there's plenty more years to come, Andy. And you know, speaking of NASDAQ, obviously there's also the example from a few years back with the Facebook IPO as well, where there were questions about, you know, whether humans being involved in that, possibly if they were on IC, what difference that would have made. But I just want to move on talking about a dislocation and working for the market and what that means. In terms of enforcement actions, which is a lot of what I cover, it seems like so much about market stability and issues surrounding that have focused primarily on high-frequency traders since the Flash Boys book and all the hoopla around that. We've seen regulators respond with cases, most notably recently the CFTC spoofing case and the Justice Department case against a UK trader who's blamed for partly helping to cause the flash crash when he's, frankly, some guy in his parents' basement trading from his own account. So sort of disturbing that someone like that could have that much of an impact on the markets. So Danielle, I just want to ask you, you know, what do you think about this focus on the HFT guys and dark pools and all these other things kind of surrounding that space? I mean, is that really where the focus should be? Is that fair? I mean, it seems like there's a lot of other things going on that's also causing volatility as well.
So I'm not sure if regular focus has been on high-frequency trading. If you look at the the two examples from the flash crash of what they say, whoever they are, say might have caused it, whether it's this one guy in his parents' basement in London or an algo in Midwest on a futures order, neither is a high-frequency trader. On the other hand, if you're a client of mine and you send me an order to buy 50,000 shares of Microsoft throughout the day, a VWAP order, which may seem like a very small, just sort of passive order, what that algo does on the back end of it to the exchanges will look like a high-frequency trader. So because it's constantly canceling, replacing, moving bids around, and trying to get the best price for the client. So it's just, there's a lot of noise, I guess, in the press and the media around high-frequency trading because it sells well and obviously it sells books. I don't think that the regulators have been focusing on that necessarily. I think they're focusing on any type of potential manipulative trading. I have a report I get every month showing me all the different regulatory actions for the month, and it's not a lot about high-frequency trading. It's a lot about just other types of trading, whether it's around the close or reporting issues, whatever it is. And that stuff's important, right? Because it's the threat of that keeps people on their toes. I think, it's a lot of people talk about it's hard to define high-frequency trading. I think it is very hard to define high-frequency trading, to my point earlier. An order that might seem like slow might actually look like a high-frequency trader. On the other hand, if there's a high-frequency trader in this room, you might not even know who it is. So I think what the regulators are doing are the right thing, actually, just looking across the board for more manipulative-type strategies or trading that might affect the markets versus just labeling, some sort of group of high-frequency traders and, ooh, like, that's bad or something.
So you think that's just really all more hype than...
I think there's just a lot of media around it, right? Obviously, there's a book that sold on it, and kudos to him and kudos to them. But it's the term out there that is almost undefinable. And like I said, it's no one's blaming the flash crash on high-frequency traders. All the noises that came out from August 24th and the various theories, and I think if you string them all together, you probably get to a conclusion. It's not a lot about high-frequency trading in that either. So I'm not sure if that's really what.
Well, what about the October with the Treasury auctions? That the government definitely did call out that industry for the volatility last fall, and renewed calls for looking at that market again. I mean, Sapna, if you have.
It's whenever there's an event like that one, flash crash, August 24th, I think the initial reaction is that the liquidity providers pulled out in the marketplace. Whether you call them high-frequency traders, liquidity providers, a lot of them are even registered market makers. I think that's the first place everyone points the finger and point the blame. A lot of high-frequency trading or liquidity provision in the marketplace is automated. It's based on human instincts, what you automate. When the market looks wacky, and your P&L calculation's off, there's something wrong in the marketplace, and people are going to react to that. Machines are going to react to that. The thing is, it's the same issue that came up when we were talking about the flash crash, and then every event thereafter. When you have, whether you're a market maker or you're not registered as a market maker and you're providing liquidity into the marketplace, there aren't enough benefits you can give to somebody to take on the obligations of being there when the market is falling to hold it up. Between a regulatory fine, if you are a registered market maker and not meeting your market making obligations or going financially insolvent, I don't think any firm's going to choose to go financially insolvent. So how do you reconcile that? We've had this conversation for years, and we haven't come up with a solution for this. And we have the same reaction every time there's a market event like this.
Well, I just have one more thing, and then we'll move on to Q&A. But just given, the elephant in the room we're all waiting for this afternoon in terms of what the Fed is going to announce, and we're talking about market stability, just curious as to, what you guys are worried about or not worried about, looking out for, just in terms of, now people think, maybe it's not going to happen, but when it does, just concerns about how the markets are going to react, and can you prepare enough for something like that?
Well, I just maybe from our perspective, I'm not sure other than our fixed income people who would clearly be doing some trading based on whatever the Fed does. Equity investors, frankly, don't give a damn. I mean, it's going to happen at some point. I don't think there's any order that's going to get generated right away because the Fed did something. At some point, you might get more involved in interest-sensitive stocks, logically, people that are going to make more money if rates are higher. But just because the Fed does something doesn't mean the market is going to move, like a herd of elephants. So But it's awfully hard to predict market behavior. I'm just hoping to get on with it.
Yeah, I mean, I would agree with Andy, ironically. Really, the 24th of August was the bigger test. I mean, after the 24th, we're perfectly prepared. Every market in the U.S. is prepared for a storm if rates move. And if they don't move, the storm will be less. So I think in terms of this industry, we are wonderfully prepared for volatility. And if you think HFTs create volatility, you should see some of these algos these guys are running up here. They're just as volatile. So, look, we're going to have a rate decision at some point, and the market's going to react. But I don't think it will look like some of the reactions that we've seen recently.
All right, great. Well, we can throw it to the audience then if there are any questions out there. And I don't know if there's a mic.
Could you just skip him?
Please. Give him the $20 back, will you?
So, go back to the first part, the least contentious part of the panel where we were talking about stability. Well, it was least contentious. It's about to get a little bit more. The July 8th incident, we now know, was because of a software change, which everyone in this room understands, the single largest cause of instability is software changes. Given that that particular change was for supporting something called microseconds in precision, which is about to get added to the SIP, which will cause virtually every trading system to have to get updated. And I'm not even sure that the industry realized this was happening, got a vote on it, or anybody did a cost-benefit analysis of this. Do we think that the current process of mandatory software changes that come down from the SROs, the exchanges, the SIPs, is actually vetted to taking into account the cost of instability that goes on in the markets? Because that process, which has to do with whether it's NMS plans or SEC rulemaking, is very different, and we're all wrestling the same thing today with regard to the tick pilot that's coming up. I'd be curious what the panelists think about the way the decision-making process actually works with regard to approving changes that almost certainly will have destabilizing, at least, risks.
Well, go ahead, Sandra. I was just going to say that, I think whether they're regulatory changes or our own system changes, we just need to have processes and procedures in place to protect ourselves from ourselves, right? So there are going to be technology issues, and we need to address those. We do have a lot of dialogue with the regulatory community, as well as the broader industry. So, I think when we're looking to put programs in place that we think will improve the market, we just need to be prepared to deal with the implications on the technology side.
I think you raised the question, Dave, of SRO governance, which is a big issue for us. The world has evolved in terms of how we look at market structure issues, how we address market structure issues, and how we change our markets as a result. I think the structure right now is that the SROs get to make a lot of the critical decisions without necessarily having the benefit of buy-side and sell-side input. I think that's something that we would want to see changed going forward. Tick size pilot is a perfect example of that.
So your question is actually timely as it's budget season at JP Morgan, and we start thinking about what we're going to be doing next year. And you just look over the next few months, the work we have to do to support 2 new stock exchanges and 2 new options exchanges. Options world is crazier than the equities. I think someone in my office made the comment there are more exchanges than market makers at this point. Any exchange that makes any change to any connection, I have to support it. And that's time and money spent on something that probably has little upside versus spending money on improving performance of algos or analytics for my clients. So I don't know how you fix that, to be honest, because those businesses have to run and they're making changes. Having 12, 13, 14 stock exchanges probably doesn't make sense, but I don't know how you dwindle that down. So if you only had half of those making changes, it'd probably be manageable. It's getting close to that unmanageable point, and any change not just takes resources away from spending money on things to help clients and client execution, it also creates risk, right? Every time you put a release out there, whether it's NYSE or JP Morgan, anyone up here, anytime you put something out, there's a chance for risk, so agreed.
So I agree we should have less exchanges. We probably shouldn't have any new exchanges either, because it just will add complexity and work to the industry. So,
Cause lots of
does that answer your question?
You know, you wonder what the marginal utility is for the things that we're doing. And for example, I'm not really sure if we need to ever be faster than we are today. But I guess we do because technology changes and things happen. But my goodness, we have put a lot at risk simply to enable speed. And that comes, I'm not sure that's to the benefit of investors. It's to the benefit of some participants, and some exchanges perhaps. But, you know, it would really be nice if everybody could step back and really take a look at what we're doing and what the costs are for J.P. Morgan to support all these different connections they have to have. Do we need that many? Is that right? Is that the best use of your money? Not for us as a client, I can tell you. I'd rather see you put it into fundamental research.
That cost just goes back.
Right. I mean,
to
it
the
gets
clients, to the individual investor in the end. So,
I mean, it's a complicated subject, but we could probably do with a timeout.
It seems like there was consensus around the idea of the need to address single points of failure. And as you guys were talking, and I haven't fully thought this through yet, but it occurred to me that a lot of the single points of failure happen to be by design or by accident, maybe single points of profit for in particular the exchanges, whether it's exchange auctions are profitable for exchanges. A lot of their other trading businesses are not profitable. The SIPs are tied into a market data system that funnels a lot of money through the system, if you will. And so as we look at addressing these single points of failure, I wondered if any of you had given any thought to, hey, what are we doing to the economics of the business if we have fully redundant everything and we don't basically allow anyone to make a monopoly profit? Like, how are we going to fund the current exchange model? So kind of a broader philosophical question for you guys. I'm not sure if any of you have given any thought to that.
Guess I'll take that. Chris would like me to open for him. You know, I think that there are alternatives in the market for all of our trading. And yes, I mean, the auctions that we have heard are important because of the price discovery process. Again, I mean, I know we've said that a couple times, but that's really the point of aggregating that liquidity at the beginning and the end of the trading day. When we look at you know, the economics around all of our pricing, I mean, it's something that, you know, we work through. But, you know, I mean, I don't think that's, I'll just let Chris go.
So, all valid points. Look, wherever we have a monopoly, we need to analyze that monopoly and look to see if number one, if the controls are in place. I look at the futures market and compare it to the world that Stacy and I live in, and it's unbelievably different, right? They have a monopoly built and sustainable forever. And we actually compete. In fact, for opens and closes, New York and NASDAQ compete unbelievably aggressively, spending hard dollars to win a listing. And that listing brings with it an open and close. So the competition to actually get there is enormous. We're competing with both NASDAQ and New York for ETF listings and going at it hard to win that listing, and then the opens and closes come with it. So there's competition around those, and there's probably some things that we all as an industry can do to increase competition around those single points of failure. The SIP is an interesting one. The SIP is an accident of history. It was the right history if you look back. I see three monopolies in our market, and I call them accepted monopolies, and some people might disagree, but our clearing houses, DTC and OCC, are accepted monopolies. We need a monopoly. We need a utility in certain areas of the industry because it's the right thing to do to consolidate capital. If you look at the organizations of those two entities, those two monopolies, they have great representation of the industry. They have sell side, exchanges, and in DTC's case, the buy side, sitting at the table at the board. The one last monopoly, accepted monopoly in our industry, is the SIPs, and it's all exchanges. And what we need to do is put the sell side and the buy side at the table for the SIP. And we have an amendment that we're bringing to the SIP. It will get voted down. I know what the votes are. I can count them right now. But we need to do this. As an industry, we need to put the sell-side representatives and the buy-side representative at the table of the monopoly. There needs to be total transparency around that. And if we don't do this as an industry, that monopoly will break, and there'll be competing monopolies. So it's, to be honest, it's a defensive mechanism to keep that thing alive.
I noticed when we talked about cybersecurity, which of course is very important, that our conversation focused exclusively on external threats and not internal threats. So I was wondering whether the panel would talk about internal threats, and the internal threats are disgruntled employees with power and access to systems, and also the potential that someday a small clearing member might actually be taken over by people who have a strong message to send to the world. Of course, it's very important because these markets seem to be the symbol of Western capitalism.
So we're headquartered in Kansas City, and we have no disgruntled employees. But and I don't want to dominate this topic, but the thing I think about is our data center, our matching engines, our entire production site is connected to hundreds of networks, hundreds of members. And each of those members we're dependent on to have their own cybersecurity. Now, when they talk to us electronically, there's a firewall, and there's a protocol that they can speak in. But we as an industry are reliant on this interconnection of networks that puts one member, one broker, could be the loose end of the entire network that lets in a cyber risk. The thing I fear about the most is when that member becomes taken over, or their boxes sitting in a data center become taken over, just pure for disruption reasons alone. And we see this disruptive activity in our market, and we don't know, either New York, NASDAQ, or BATS, we don't know it's actually disruptive behavior. We just see volatility, and by the time we catch it, it's too late. It's already disrupted our market. So I'm very fearful around the production networks, and that's where everyone is hardening kind of their moat around those networks and putting in firewalls. So I'd say we're very protected, but it just takes one access point to blow up the whole system.
I mean, I have similar thoughts, and also I would just say, as far as like disgruntled employees and things like that, I think in the same vein, we take a risk-based approach to cybersecurity and identifying what are the assets that we really need to protect most closely and have the appropriate measures around those. And so we do that and have controls around who can access what systems and where and things like that.
Next question, I think, is one here.
So I just wanted to speak up for the sort of underrepresented investors in the market quality discussion, and that I would consider to be portfolio and index traders, and of course that means ETF traders. So, it's interesting because there's a lot of parallels between the crash in '87 and August 24th. I think that it was I was very scared at that open in the same way I was in '87, because there is still not this recognition that we have an integrated, or we should have an integrated equity trading system where there are a lot of top-down investors who legitimately want to use those markets, right? On any given day, there may be 25% of trading activity, right? On a day like that, they want the markets there for them to participate in, to adjust their holdings, and they're using ETFs. So I guess I would ask, how are you going to be rethinking the reforms to really take into account the needs of these portfolio and index traders and how they depend on the integration of not just all your markets, but the futures markets, right? The upstairs portfolio trading, capital commitment. I mean, this is a really tough problem. I know you can't answer it up there, but I just think it should be part of the dialogue a little more.
No, we totally agree, and I think that how what the appropriate market structure for ETFs is very important to us. And on NYSE Arca, we list 94% of the assets under management in the equity trading product asset class. So we take that very seriously. We're actually hiring an external consultant to do an overall ETF market structure review because we think it's time to make sure that we're looking at the different changes we've put in place. And I think one of the other things is, we can look at limit up, limit down, and how it could be appropriately adjusted for ETFs. We can look at collars and auctions and all of those different things. But one of the primary issues that we need to address is how do we get more liquidity in the products, and how do we get market makers to have the right incentives to be there. They're never going to stand in front of a running train, but we want to make sure that we're giving them incentives to provide liquid markets.
So I agree. Look, the passive investment product, called the ETF, the ETP, is exploding on the scene. It is 25% of our market, sometimes a third, and it will go up to 40 to 50% shortly. If you think about robo-investing and the amount of capital going into robo-investing, when you say robo-investing, what you're really saying is ETF trading. All robo-investors use the ETF portfolio to actually reweight their portfolio very quickly. So the amount of capital that is shifting into that ETP product is extraordinary, and it will continue. And our market will be 50% ETF volume, 50% straight equity volume. And we are not prepared for that. We haven't built the systems, we haven't built the market structure to align some of these ETFs with the futures market. For example, the futures went limit down, and they were limit down for a long time. And we were opening our market, and we were going limit down. So there just needs to be more coordination around the futures market, but we do need to adjust our limit up, limit downs for ETFs in particular, and we need to think about how we come out of a halt for ETFs. And there is a value, there's an indicative value of that portfolio, and we can't open if the value of the ETF is completely disconnected to the value of the portfolio. We have to have more work done around that. And we have to actually, what's amazing about some of the mispricings of ETFs is those are huge profit opportunities for market makers. They don't want to miss that when the arbitrage breaks. But the risk that they had entering and getting halted again, because there was way too many halts in the ETFs, what we saw in the ETFs was after every halt, and it was really around the ARCA halt mechanism and how their auction worked, which was collared, which they widened out the collars later that week. But we saw a few ETFs where you had 10 to 12 market makers at the beginning of the first halt. By the fifth halt, there was one. And that's not what those halts are designed for. So it caused this manual mode for market makers, and they couldn't come back in. So we have a lot of work for ETFs. But the theme is these products are going to overtake most straight equities, and we need to have a market that is designed specifically for these products.
I think that's important to acknowledge what Chris just said there in terms of the growth in these markets. But two things, and Joanne, I was around in '87 too, so thanks for that memory.
I think the market opened at 9:30 in '87.
It probably did. That's right. But a couple things. Clearly, markets have to be coupled, and we saw on August 24th what happens when they're not coupled, and it's crazy for an ETF to open when the underlyings aren't, and vice versa, or a halt to happen in one when that hasn't happened in the other, and that doesn't seem to make sense. But I would, a note of caution here. These ETFs have been adopted so broadly as if to assume that everybody can buy oil stocks at the same time and a basket of oil stocks. Well, guess what? You can't. And I'm not sure the people that have sold these products have fully shared that acknowledgement and that clarity.
Between thinking you can sell IBM at the same time.
Well,
it's 2% of market cap outstanding.
but if you come to IBM and there's nothing but sellers, there's going to be an imbalance, and potentially it would be halted, or there would be some dissemination of that. In the ETF world, you got everybody saying, I'll be a market maker here and there. I'm not sure you know the derivative imbalance for a while, and that's where you often get, misled, it seems to me. So I just think we need to be a little cautious here in as we think about how to solve this problem.
Do we have time for one more? Yeah, maybe on the side of the room.
Hi, I'm a lobbyist. I represent a new exchange, or one that will soon be new.
If it gets approved. Right?
Yes, that's right.
Okay, got it.
And I guess the question I have regarding the definition of HFT, and I saw Mr. Cement and Mr. Kincannon both used algo routines as an example, or VWAP trades, I think you gave as an example, of what is probably a very innocent form of what could be, almost confused with a HFT. And my question is, while I think everyone in the room would probably want to acknowledge that a VWAP trade or a midpoint passive trade is truly innocent in the world, in the fact that it's passive, I guess, would you both differentiate that from any sort of transaction that seeks to, say, benefit from a proprietary feed that is faster, so something dealing with, in effect, extracting stale pricing from a slow SIP, or locational pricing where you actually just have literally time delays across exchanges that are located in different places?
I'm not sure I cut all that, but I'll try to answer it anyway. So actually, I think your firm or the firm you lobby for is a great example of markets solving their problems without waiting necessarily for a regulatory process or a political process that may take a while, right? So you're referring to a latency arbitrage, and is that a disruptive strategy? There was a book, and all of a sudden you have a sort of solution for that around the toolbox or the wire or what have you.
It's the magic shoebox.
Magic shoebox, too. Yeah. Sorry. We are the #1 broker there, though. I just don't know the terms. But what you've seen, which is interesting, is that's evolved, right? So the participants, and I don't believe that people should be, criminalized, so to speak, for investing and spending money to get as fast a data as possible, because you don't want to stifle innovation, right? But you also need to protect individual investors and other investors who may not have those resources to try to create a fair marketplace. And IEX is a great example of that, where that's a solution, and the market can decide with their feet if they want to trade there or not trade there. That solution went out, and then things changed right away, and you can see the participants change their strategies, and you guys had to adapt to it, and things are moving around a little bit. I think that plays to my point of, it's not just one thing that you've got to look at, right? It's not a high-frequency trader necessarily. It could be a high-frequency trader. It also could be a trader that's overseas somewhere, or a bunch of traders overseas somewhere, or it could be just someone sitting at home in their parents' basement in London, right? You got to look at all that stuff rather than just focusing on one area and know if it's disruptive trading versus just throwing out a label of high-frequency trading and calling it good or bad.
Yeah, I'm not sure what your question was. I honestly, I wasn't listening. You said something about direct feeds, and I was thinking, well, geez, I think you're going to have a direct feed yourself. Kind of have to, yeah. Okay, well, you mentioned speed arbitrage. That's usually the direct feed issue. Look, I agree that this market, if you look at the exchanges that we have today, they were all born by innovators. NYSE is built on NYSE Arca, Nasdaq's built on Island ECN, BATS was a BATS ATS. We were all born as innovators. We can't stop letting the market innovate. We've benefited dramatically from the innovation that we have, and it's an impressive, you can't find that in overseas markets. They just don't have the same level of innovation. So the more the merrier. I can't wait for you to start filing 19B4s with the commission. It's a really fun process, and I welcome you into the pool.
Thank you for acknowledging the more the merrier. There we go. I'm not in the favor of the more the merrier. I'd like IEX to be successful, or at least provide innovation and make the markets better, just as I would anybody else. But I do think it's important to acknowledge a couple things here. It's not good public policy that we allow some market participants to get an advantage of information at the expense of others. That just doesn't sound good to me. That does not instill investor confidence. Now, if you're clever and you've invested and, it's America, terrific, go get it. But if we have a tax loophole, we need to close it. If there's a loophole of information and things where somebody gets an advantage that they're not entitled to and shouldn't have, we ought to address that. There are lots of high-frequency trading strategies that are statistical arbitrage and good things. But there's some things where you're just trying to flank everybody and you don't really have an order. And by the way, it's not 100 shares anymore. It's one share to find out what somebody else is doing. And then you go around this way to take advantage of that. And I don't think the markets were designed for that. So let's get back to who fights for the markets. And by the way, just because I can't resist, but dark pools were given a free pass to establish and promote block trading or bigger trading size. And the perverse has happened, the opposite. There are now smaller trades in dark pools and on the lit exchange. That pass should be removed. That pass should be withdrawn. Can we talk about that, please? You want to clean this up? You want to play? You've got to present your order flow to the marketplace. That's how we get price formation.
I totally agree with Andy.
And by the way, this has nothing to do with who has market share and who doesn't. But you can't trade in the closet without sort of giving something up, seems to me.
And I think with that, we're going to have to end it. I think at the very least, we all agree with Andy, so we're all good. Thank you, everybody.